Vadakkam, Namaskara and Namaskaram, and welcome to this session of the Valuation. And yes guys, we are going to start today the 100 marks paper of your syllabus. It's an elective paper which is paper number 20A, which consists of two parts: strategic performance management and business valuation. Business valuation being 50 marks syllabus, and strategic performance management being the rest of the 50 marks. Paper has been divided into two equal sections, 50 marks each of SPM and business valuation. Now, first of all, before starting the entire syllabus, let us understand the course content and let us understand the nitty-gritties of the course and how the course is culminated. So we have two sections. Section A, which is strategic performance management, which will be dedicated to analyzing the performance of any company. So guys, we are aware about the financial statements which are prepared for any company, and you know, since our 11-12 standard, when we were in our 11-12 standard in our school times, we used to study this concept of preparing the financial statements, which is balance sheet, profit and loss account and cash flow statement. Now, the objective of preparing this statement, financial statement, is not just to make the statutory compliances, is not just to fulfill the requirements of law, which is the Companies Act. The purpose is also to analyze the financial performance of a particular company, to analyze whether company is on the right track or not, to analyze whether company is doing the right things or not to attain its future goals, future profitability goals, or future consistency market capturing goals, whether company is able to acquire all those expertise, acquire that benefit in the future. The objective is not only to prepare the financial statements according to accounting standards, but also to analyze them, because only after analysis will we be able to know whether the company is doing fine or not. And what will help us in doing this analysis? Certain tools which are there in our syllabus of strategic performance management. What is the meaning of performance management? It means that we need to ensure that the performance of any organization, performance of any company, performance of any partnership firm or any other business organization is up to the mark, is absolutely perfect, is absolutely what the expectations are of the stakeholders. It should be as per the expectations of the stakeholders, and that is the idea behind introducing strategic performance management. This particular part of your syllabus will contain broadly 4 chapters. First 2 chapters will entirely be dedicated on performance evaluation, how to evaluate performance of a particular business, particular organization, be it a company or a partnership firm or any other kind of organization, how to evaluate the performance. First 2 parts are dedicated entirely to that particular section. And yes, let me give you certain hints, guys. In your 11th standard, you had studied a chapter called ratio analysis. What is the current ratio of a particular business? What is the quick ratio of a particular business? What is return on equity? What is return on investment? What is fixed assets turnover ratio, or debtors turnover ratio, or sales turnover ratio? All these things we had studied in our 11th standard, which related to performance evaluation. So that will be the starting point of our performance evaluation. Apart from that, we'll have multiple more avenues, multiple more things to be studied in these 2 chapters to evaluate our performance of a company, whether it's doing fine or not, whether it is down with sickness or not. So guys, yes, we fall ill, right? We have viral, we have running nose, we have cough, cold, etc. We fall ill, we fall sick. Soon as we fall sick, we diagnose it, we get it diagnosed, okay? Whether it's normal flu or whether it is normal viral, or is it something much more than that, we try to diagnose it, okay? And after diagnosing it, we go to the chemist shop and buy some medicines, of course, in relation to in consultation with the doctor. We buy some medicine and we treat that sickness. Similarly, even the companies suffer from sickness. Even the companies suffer from some illness. And what is that illness? That illness is not reaping the appropriate profits, not really attaining those objectives with which the company is created, not attaining the market size, not attaining the desirable profitability, not attaining the production capacities, etc., etc. This is the sickness, this is the illness which the companies sometimes suffer with. And the companies, while they suffer with all these illness, all these sickness, 2 things are required. Number 1, diagnosis. we need to understand at a very early stage, guys. That is most important thing. Okay, whenever we suffer from some disease, we ensure that, and we would want to get diagnosed at a very early age, because further we reach, difficult will be the treatment. We need to get it analyzed really early. So the first step is to getting diagnosed very early, so that suitable medication can start at an early stage. So one thing which we need to study in our performance evaluation is that, how to assess the sickness of the company, how to assess that these are the symptoms which the company is given, which tells me that this company is sick, or it is in the process of getting sick. What are those indications? What are those identification marks which tell us that, okay, this company is getting sick, or it is already sick? So that is one thing which we need to identify. And then of course the medication part, how to ensure that that sickness is removed, or if the sickness is incurable, then we need to ensure that that part of the company or that entire company is liquidated, or it is just wound up, so that no further losses sustain in the business. So that is the kind of evaluation that we are going to study in our strategic performance management. Apart from evaluation, we are also going to see certain risk management techniques. So every business suffers from a risk, political risk, money, currency risk, export risk, government policy risk. There are many risks which a businessman is faced with. Physical risks like fire or some strike with the management of the company or the laborers. These are all the risks which a company suffers from. And guys, all these risks are definitely not avoidable completely, but they are avoidable to a certain extent. They are controllable to a certain extent. You cannot eliminate them completely. Business risk cannot be eliminated completely, for sure. But yes, to a certain extent you can control it. You can employ some procedures that can control those business risk, and assist you to develop some mechanism that can control the losses which you suffer from the risk. So that is the thing. So the thing is that we need to first identify what risks the business suffer from, and then what are the fences, what are the mechanisms that we need to install in a business so as to ensure that the losses from this risk is minimized to the minimum level. That is the concept which we are going to study in our strategic performance management, which is risk management. That is another aspect of our syllabus. Then the next aspect will be economic efficiency of a firm. Okay, now guys, when we were in our 11th-12th standard, then in the economics subject we used to study the average cost principle, the marginal cost principle, the profitability analysis, what are the profits which the company will yield, what kind of cost will it have, etc, etc. All these things in economics we used to study. All those concepts which will analyze the economics of a particular business, which will analyze the economics of a particular organization or a company, we are going to study over here as well. But so we don't remember anything in economics, what we did in our 11th, 12th standard. We don't remember anything. No worries at all. I will teach those chapters of economic efficiencies in a way that even if you are a science background student and you've never studied economics ever in your life, you'll also be able to understand each and every bit of it. So guys, during entire classes of business valuation, SPM, as well as cost audit, because cost and management audit also I teach, I will ensure that I start all the concepts from the basic level, and I will ensure that I am not under an assumption or a presumption that you know certain things. I will always presume that in the past you've not studied anything, and yes, of course that's not true, but I will assume that in the past you have not studied anything, and I will start everything from a basic level, from a grassroots level, from a basic level. I will start everything. So don't worry about that. Be it economics, be it financial management, which will be used in business valuation, be it any kind of concept which you have studied in your intermediate, I will teach you all those concepts, assuming that you have not studied for your intermediate, or you've studied but you've forgotten everything, and I will start from the basics. So don't worry about that. Okay, so that's about SPM, strategic performance management. And strategic performance management will have a mix of theoretical and practical questions. Business valuation will not have theoretical questions, it will only be practical questions, but SPM will certainly have a mix of theoretical and practical questions. So both of them will be there in your paper in a mixed form. So take a note of that. And yes, SPM, BVM, both will have 100 marks of questions to it. Now coming on to BV, business valuation. In case of business valuation, entire paper will be practical based. Okay, only those MCQs, 1 mark, 2 mark MCQs, or some basic theoretical question can come in the examination, but primarily it will be practical. And what will valuation entail? Guys, valuation means to value something. Valuation means to ascertaining a value to something, to fixing a value of something. That is valuation. And please mind one very important thing while we are starting the subject, although we will not discuss in detail, but please mind one thing. Price is an entirely different concept as compared to value. Value is a different thing, price is a different thing. Value is different, price is different. Both of them are two different things. Value has nothing to do with price. Price is a different concept altogether, value is a different concept altogether. So you need to learn first thing that value and price are two different things. And in this particular subject, which is business valuation, I'll be harping upon value, how to compute value, and not on how to compute price. That is the benchmark, that is the basic thing which I'll be harping upon on this particular subject, which is business valuation. So yes, business valuation will contain valuation. How will we do valuation of various business assets? No, we are not going to value gold. We are not going to value any personal asset. We are not going to value anything which is not related to business. We'll value every asset which is related to business, like including goodwill, shares, and during merger and acquisition, how can a company be valued? How can an entire business be valued? How can assets and liabilities of a particular company be valued? We'll be discussing all these things in great detail in this particular chapter, subject called business valuation. So the most important chapter of this particular subject will be valuation of mergers and acquisition, because a fixed question of say 10 to 15 marks will definitely come in the examination from this particular chapter. Valuation of merger and acquisition, very very important chapter. And yes, by the time I scroll through all the chapters and I take you through all the chapters, I will be explaining what are important parts of the syllabus, what are not so important part of the syllabus, which parts can you just quickly go through and not pay much heed to it. I will explain you all these things while we carry on this particular journey called the SPM and the business valuation. And yes, let me tell you the importance of this particular chapter, guys. So this particular subject, guys. So this particular subject is not only relevant from an exam standpoint. Of course, we need to complete the examination well. We need to cover all the aspects of our examination very well. That is a prerequisite. That is a sine qua non, which is a mandatory thing. That yes, that is the first objective. But along with that, I will ensure that you get some practical insights into valuation after completing the subject, which means that if in the future you decide to pursue business valuation or investment banking or seed funding or angel investing as your career, if you wish to do that, then you get some practical insights into valuation as well. So guys, during my stint of 12 years working with the big fours in their audit and tax divisions, I got a lot of practical exposure to how audit is done. And that experience I'm going to share in my cost audit classes, cost and management audit classes. I'm going to share them threadbare in those classes. And in these classes, valuation, I'll be sharing my experience with respect to valuing assets and liabilities, and especially, income tax has got specific sections, specific rules on how to value assets, 11 UA. So how to value assets. Those valuations were again done by me based on the valuation technique. So I'll be sharing practical insights into the valuation bit and the performance management bit during the course of this particular lecture series. So if you have bought this lecture series, please rest assured that entire study mat of the CMA Institute will be covered in this particular series, and your books material which I'll be providing to you. So you need not refer to any other material. But yes, you should refer to the MTP's RTP's scanner so that you understand that which chapters are important, which are not important. Although I'm going to share details of important chapters, important questions in the entire session as well. So that is not a problem. But still, if you want to refer to anything, MTP's, RTP's suggested answers are the best source of knowledge for you. Best source of culling out this information will be these three things. So yes, please refer to MTP's, RTP's. No other book is required to be referred to you to, but yes, one thing is for sure that as compared to cost audit, BVM SPM syllabus is a little vast syllabus. It's humongous as compared to cost audit. Cost management audit syllabus is very narrow and very limited to certain things, but the syllabus of business valuation is quite detailed. Okay, let me give you some interesting insight, guys. In syllabus 2012, now we are dealing with syllabus 2022, right, which is the latest syllabus. But in syllabus 2012, which was 10 years back, SPMBV was the subject. It was named as business valuation only, and the portion that you are studying for 50 marks, at that point in time it was for 100 marks. And without deleting even one topic, even one chapter of the old syllabus, we have the institute has given it as same in the new syllabus, and institute has marked it as 50 marks, and with SPM the rest of the 50 marks. So that is the depth and graveness of this particular subject. It is going to be huge, vast, but we are going to definitely apply our brains while looking at or while seeing this particular chapter, so that we are able to objectively assess which chapters are important, which chapters are not important, and give more emphasis to the important chapters. That is the idea. We need to enter into some smart study, and I'm going to develop that acumen in you to study smartly. But yes, I'll be covering the entire syllabus fully, so no compromise on that, no restriction on that. I'll be covering the entire syllabus fully, but yes, I'll be telling you that this particular part of the syllabus can be you can go easy on it. Okay, so I'll be guiding you entirely through and through in this particular video lecture, so don't worry at all. Business valuation and strategic performance management is now my responsibility towards you. So yes, what are we going to start today, sir? We are going to start business valuation today. We are going to start the section B today, which is according to me a very, very important section, not only from an exam standpoint but from your practical understanding standpoint also. This is a very, very important section. So we are first going to start business valuation, and then we will come on to the strategic performance management bit. So let's start business valuation, and the first chapter which we are going to start today is the basics of valuation. Now, what do you mean by basics of valuation? Guys, basics of valuation means in this chapter we are not going to start valuation directly, but we are going to understand what do you mean by valuation. First of all, what is the use of valuation? What is the relevance of valuation? Why is valuation so necessary for any business? Then we are going to study what are the methods of valuation during the valuation process. What methods do we need to employ in the valuation process? What are the approaches to valuation? Then how is value different from price? I had already given you a hint that value is a completely different concept, price is a completely different concept. What is the difference between these two things? All these things we are going to study in our chapter, which is basics of valuation, and valuation models also is included in this chapter only. So I have covered 2 study notes in one chapter, which is study note number 5 of your CMA Institute study mat, and study note number 7 of your CMA Institute study mat. Basics of valuation and valuation models, both of them I've covered in my first chapter. So let's start business valuation, chapter number 1, basic concepts. Okay, now before coming on to what is the difference between valuation and price, what are the techniques in which we value a particular thing, a particular asset, like especially a business asset, what are the processes? Before coming down to all these things, guys, first of all, let's understand what is the purpose behind valuation. What is the use of valuation? How is valuation relevant? And at what all places can we use the valuation techniques? Let's understand that first. Okay, what are the purposes of valuation? So first of all, whenever you want to list your company in any stock exchange, that is initial public offer, then valuation is very, very relevant. Now, sir, we want to list our company in stock exchange. Why is valuation relevant over there? Because, guys, the price which you're quoting for your shares, for the shareholders to buy, that price, whether it's worth it or not, that is the question which every shareholder will have, or every future shareholder will have. The markets will have the same question, that you are offering your share at the rate of say 120 rupees, whether it's worth it to spend 120 rupees for a company like yours. That is the question which you are going to face from the shareholders of the company, from the management of the shareholders of the future shareholders of the company. The management of various investment funds will ask you this question. So to understand whether the price is in cognizance with the value, whether the worth is there or not, value is required to be ascertained. Okay, now imagine a situation where you are going to a market, okay, and in the market you are going to buy some clothes, okay, and suppose you like a cloth which is 100 rupees for 100 rupees, and you tend to bargain with the shopkeeper sometimes that it's not worth, this good is not worth this price which you are selling it for. No, in the other shop it's being sold for only 80 rupees, then why don't you charge only 80 rupees? In the other shop it is only being sold for 80 rupees. So we tend to sometimes bargain. We sometimes tend to analyze the worth of a particular thing, whether it's worth spending this much amount in this particular thing or not. You think about this particular concept in every buy that you make, every buy decision that you make. You know, imagine for 100 rupees you are thinking so much about the worth. Imagine buying a company worth rupees 100 crores. Won't you enter into a detailed exercise to determine whether value is in cognizance with the worth that that company is bring to you? Won't you have that kind of an analysis in mind? Of course, yes, you will have that kind of an analysis in mind, that, you know, whether whatever I'm spending to buy this particular company or this business or this asset, whether it will be worth it or not, whether I'll reap benefits out of this spending or not. So yes, during your initial public offer, whenever you are entering into a stock exchange, getting your shares listed in a stock exchange, valuation is definitely required, and usually the person who's purchasing your shares, he'll get the shares valued. Second, mergers and acquisition, guys. Today is a highly competitive market. Okay, today's economy is highly competitive. Daily there's a news of a big giant company acquiring a small company, or two companies amalgamating together to continue their business, to meet the sharp the demand, or to meet the sharp competition in the market. To meet any of the objectives, there's a lot of merger and acquisition happening. There's a lot of asset purchase happening, buyout of a particular division happening. So, you know, some people sell off their loss making division, or a division which is not earning so much of profits. They sell it to certain other company to manage it, so that they can manage the core things well. In all these processes, mergers, acquisition, buyout, in everything, guys, valuation will be of paramount importance, because there will always be a conflict between the buyer and seller regarding the price. Whatever price the buyer will expect, that will be substantially different from what seller is going to offer. Because of that differential, you always pin down a value to that particular company, so that that pricing decision becomes easier for you. And that is where valuation comes into picture. So valuation is required in merger and acquisition, buyout, business restructuring. So if you are doing internal reconstruction, okay, or you are doing some amalgamation, mergers, acquisition, or any kind of internal reconstruction, business restructuring you are doing, then again valuation will be of importance, because that will tell you how much is the worth of your business which you are trying to restructure. And that will be helpful to make a decision whether you want to go with this restructuring or not, whether it's worth it or not. Because, you know, I cannot expect that a business which values at 1 crore rupees, I spend 1.5 crores to restructure it. I will not do that. Okay, so restructuring exercise will definitely involve your valuation inputs to it, so that that exercise is done objectively. Then shareholders dispute resolution, whenever shareholders are in dispute with the management of the company, and this happens quite often, guys. Shareholders don't have access to the company, so whatever decisions are taken, they're taken by the board of directors on behalf of the shareholders. In that scenario, guys, there is obvious reasons for shareholders to dispute certain things which are being done by the board of directors without cognizance of the shareholders. So there will be certain disputes which will always arise. As a outcome of those disputes, the shareholder might say, I don't want to be a shareholder in this company anymore. Please give me my money, take back your shares. This can very much happen. Under this scenario, valuation will be one thing which will be of use to you, which will be of a savior to you. It will be a savior to you. Valuation techniques will value your business and will remit the money to the shareholders. Their equity value will be remitted to them. Okay, so shareholders dispute resolution, again important from a valuation standpoint. Purchase, sale of business, or liquidation of a company. Whenever you are purchasing or selling your business to a third party, or you are liquidating the company, which means you are dissolving the company and selling its all assets and liabilities. In that scenario also, guys, valuation will be of very good importance to you, basically because, you know, valuation will ensure that the exchange price which is fixed is true, is fair to both the parties, both the buyer and the seller. Okay, usually what happens is the buyer will always try to reduce the price of the particular asset being sold, and the seller will always try to increase the price of the good which is under consideration. To achieve at a fair value, to achieve at a mediocre price, to achieve at a price where both the parties agree, we need valuation techniques, we need valuation concepts. That is the area where valuation concept are going to significantly contribute. Then insolvency means where the assets are much less than the liabilities of a particular company or a person. Assets are much less, liabilities are much more. In that situation, guys, insolvency happens. And in case of insolvency, what happens is all the assets are sold in market, and whatever is the residuary figure, or whatever is the residuary cash flow which is arranged, that is distributed amongst the shareholders or the stakeholders like creditors, etc. So in case of insolvency, where your assets and liabilities are much less than your assets are much less than your liabilities, your net worth is eroded. In that situation, guys, valuation is required to ascertain what is the value of the assets which the company hold, and what is the expected liquidation value which the creditors or the outside liabilities will take. Then last but not all the least, financial reporting. Now the question is, what is financial reporting? Guys, you have a subject called corporate financial reporting, right, in your CMA final group 4. What is financial reporting? Financial reporting is how to prepare financial statements like balance sheet, income statement, cash flows. That is financial reporting. What is the format that we need to follow? What are the principles that we need to follow? All are given under the accounting standards or the Ind AS as per the requirements of the company. Now, the purpose of valuation is also to report the financials of a particular business correctly. So, but according to the Indian context, in financial reporting, always and always historical cost is taken. Historical cost is taken, and never the current market price. So I'll give you an example. I bought a building for my business 10 years back. After putting depreciation for 10 years, now the building stands at 2 crore 50 lakhs. It was purchased for 80 lakhs. It was purchased for 80 lakhs, and after 1 year of purchase, its value rose up to 8 crores. Okay, 50 lakhs versus 8 crores. Now what I decide is that a part of the building I will keep with me, and rest of them I will sell. In that case, of course, the books of accounts will reflect only the purchase price, which is 50 lakhs. It will not reflect the fair value which is there today. Okay, so financial reporting will primarily be connected with the historical cost accounting, which is the old accounting standards. But now, as per the new accounting standard, which is Ind AS coupled with IFRS, according to Ind AS, guys, every asset is to be valued at the fair value and not at the historical cost. So now, if I have a building, whether I want to sell it or not, it is irrelevant. If I have a building, if I have a property which I am using in my business and I want to value it in my balance sheet, I will no longer recognize it as my assets which are the historical cost assets. I will not consider the value as historical cost. I will consider the value as fair valuation as per the Ind AS. And for computing the fair valuation, of course, valuation is required. And therefore, in financial reporting also, financial reporting contains certain valuable insights to the valuation. Valuation is useful in financial reporting as well. That is where financial reporting is also used in the valuation process. So in a nutshell, the purpose of valuation are many. These are just tip of the icebergs which I have touched upon in this particular discussion, guys. But the purposes of valuation, the uses of valuation, the way valuation is done, and the techniques of valuation which are applied, they can be applied in multiple situations and circumstances, especially in a competitive world like today, where there is cutthroat competition in everything that you do, and you want to be better than your competitors, and there's new strategies which are being devised every day. Yes, doing business has become innovative. Doing business has also become very, very competitive. In this era, valuation is definitely significant. And trust me when I say that, when you become a CMA, a qualified CMA, then one of the career opportunities that you can definitely look at is being a valuer. Being a registered valuer, working with the industry, something like an angel fund or a registered valuer with investment banking organization. All these things are very, very important because the purpose are many, the uses are many, and the valuation professionals are very few in today's industry. Very, very few valuation experts or valuation professionals are there today. So it's a very, very booming career. It's an interesting career to pursue. Now, one thing which I want to clarify over here is, you might have this question in your mind also. That's which law has all these rules related to valuation written? Which law does it refer to? So whenever I want to value my business, I want to value my assets, and I want to really, sell off my business or sell off my assets to a third party, which law should I refer to? Which law, which provision will tell me what is the valuation technique which I'm going to use, what are the methodology which I'm going to use, how to do the valuation? Which law will tell me, sir? The answer is there is currently no law in the country which tells you about how valuation is to be done. There are valuation standards which are the international valuation standards which are there, but they are not, hard and fast. They are not absolutely arced in, a stone, and it's not mandatory to be applied by the companies in India. And therefore, the valuation in India is not a subject matter of law anymore. There's no legal framework which is surrounding valuation today, but the valuation is a matter of personal discussion, or discussion between the two parties, the buyer and the seller. The discussion between the two parties regarding the value, it all depends on your skills of valuation. So it's all practical knowledge, nothing related to law. Law cannot tell you that value this thing according to this or that. Law will not tell you about all these things. There are no regulations which are made. Yes, it is an individual exercise. Buyer will always try to reduce the price, seller will always try to increase the price. So they will ultimately come to a middle conclusion, come to a middle path while valuation is being done. So there's no law in the country which is dedicated to valuation. Valuation is just a matter of expertise, it's just a matter of experience that you gather. Doing valuation over a couple of years and doing valuation again and again, you get expertise in that particular sphere. Yes, there are guidelines which are recommendatory guidelines, not mandatory guidelines. It will also be subject to various subjectivities, various permutation and combination will be applied in those eventualities also. For example, valuation depends on who is doing the valuation. I'll give you a very practical example which I faced in my professional life, guys. I had to purchase my office. Okay, so I had left my job in one of the big fours and I had to purchase my office where I want to start my teaching career. And that office could have been located in Delhi. Okay, because I'm staying in Delhi, it was located in Delhi. Now in Delhi, there is an area called Lakshmi Nagar. And that area is famous for all the CS, CMA students coming over there from the entire country and staying over there and taking coachings of various subjects. Now there are PGs, there are libraries, there are all the faculties who are there who have taken their big premises on rent and they run their coaching institutes over there. That is the place which is very, very valuable for me. I went to see an office and that office was about 150 to 180 square feet and square yards actually, and that was costing me about 40 lakhs. Okay, the price of that office was 40 lakhs. Okay, the price was 40 lakhs of that office which was located in Lakshmi Nagar. Now guys, 40 lakh rupees for that particular area. I was getting a similar area in terms of size. I was getting in another location which is nearby Lakshmi Nagar, which is Daryaganj, at only 35 lakh rupees. Same area. And the locality was also similar. I was getting for 5 lakh rupees less. But no, Lakshmi Nagar was more valuable for me. Why? Because all the CS, CMA students gather over there. They have their PGs, they have their libraries over there. So all the students accumulate from the entire country in Lakshmi Nagar. So I don't mind paying 5 lakh rupees extra for that office area, which was situated in Lakshmi Nagar. As compared to me, there was another client which was there, which was negotiating for the same place. He had a CMA practicing firm. He was a practicing CMA, cost accountant, and he had a firm. He wanted to open his firm in that particular area. Now guys, that particular person who had a CMA firm was willing to buy that particular place, but when he realized that in 5 lakh rupees less you have a place available in a similar locality, he didn't buy that Lakshmi Nagar wala place. He went to buy the place at Daryaganj. Why did he do that? Because for him, that location is not that valuable as compared to what it is for me. For me, I was planning to open a coaching institute over there, so I did not mind paying 5 lakh rupees extra for that place. But that particular person didn't want to open a coaching institute, but he wanted to start his CMA practice. So he was not willing to shell 5 lakh rupees extra for that place, which was, he was getting in Daryaganj, which was a nearby locality, and he was getting it for 5 lakh rupees less. He was not ready to pay 5 lakh rupees more. That is the kind of, difference or subjectivity that you can get in valuation if you do valuation from different perspectives. So value may vary from person to person. A person may give more weightage to a particular area. Other person might not give that much weightage for that particular area, and valuation may vary from person to person and area to area. And that is the subjectivity which valuation comes with. Okay, so yes, that is valuation. Now coming on to one of the principles which I'm discussing about this principle regularly with you, but I've not discussed it in detail. Now let us look at this principle, and the principle is, so what is the difference between price and value? Now guys, the difference between price and value I've just explained you in my last example, guys. So if you ask me, that office was offered to me in 40 lakh rupees. I could have easily paid 45 lakhs also for that office. I could have easily paid. Why? I did not mind any extra amount that I wanted to pay for that particular office, because I knew that I will get the required returns from that office. I knew that faculty members earn so much that they are going to recover all their costs, and it will be profitable for them to get an office at an extra price at that place. But that place was very important. That location was very important for me. I was ready to pay 45 lakh for that particular flat. Also for that office, I was ready to pay 45 lakhs. So price in that case was 40 lakhs, which I paid. Value for me was 45 lakhs. And that is the difference between price and value. Let's read what Warren Buffett has to say about price and value. And Warren Buffett is the undisputable king of the stock exchange world, where he had earned a lot of money. Berkshire is the company which he had formed. It invests into stock and it earns money. So Warren Buffett says that price is what you pay. That was 40 lakhs to me. I paid 40 lakhs to buy that office. And value is what you get. So what was I getting? I was getting value worth rupees 45 lakhs. But how, sir? In form of revenue from my students. I was getting that kind of money back. So price is what you pay and value is what you get. That is the difference between price and value. This difference will always be there. Sometimes price will be higher, value will be lower. Sometimes value will be higher, price will be lower. Price is easy to ascertain. How is price easy to ascertain? Price is actually the value which is there in exchange, which means the economics of demand and supply. Wherever demand and supply will intersect, there price will arise. Wherever demand and supply will intersect, at that point in time, price will arise. So price is value in exchange, the value which will be derived in exchange while you are exchanging two goods, which will be determined by the basic economical principles of demand and supply. So whatever is the demand and supply equation of a particular good, guys, that particular demand and supply will determine the value, the price of a particular good. It depends. Now if something is demanded at a very large level, even if it has no value, then also, guys, it will be more priced than other things. I'll give you another example. Okay, I was looking for a house for myself, and my budget was 1 crore rupees. I want to buy a house in Delhi in 1 crore rupees. Now obviously Delhi, Bombay, Chennai, Kolkata, these are metro cities, so property or real estate values, the prices are really high in these particular areas. So guys, I had 1 crore rupees and I saw a flat in Delhi, a beautiful flat, 2 BHK, and it was offered to me for 1 crore rupees, a decent locality. Okay, now when I went to Bombay, and just for my experience sake, I asked some broker to show me some flat within 1 crore rupees. In Bombay, in 1 crore rupees, the kind of flat which I was getting, it was too small as compared to what I was getting in Delhi, and it was too tacky. The locality was also not good enough, which brings me to a point that price is not about value which is given to you. Price is about demand and supply. Bombay has got a lot of demand for real estate. It has got a lot of people who are wanting to buy houses over there, and that too, a lot of people are wanting to buy lavish houses, and they have a lot of money over there. So Bombay has got a lot of demand, supply is less. Therefore, even if the thing is not worth for 1 crore rupees, it is getting sold for 1 crore rupees. However, in Delhi, as compared to Bombay, the demand is not as much, so I'm getting a better house in Delhi. Same if I move to Jaipur, I will get even more amenities in my house as compared to Delhi, because of the demand supply function, guys. What is the intersection point of demand and supply? That will determine the price of a particular asset. That will determine the price at which that particular asset is sold in market. And that is the trade-off. You know, demand and supply will determine the price. Whether it's worth or not, we are not, you know, bothered about worth or anything like that. Anything which is derived from demand and supply intersection, that is known as price, and it is value in exchange. Exchange means that transaction, that dealing which happened of buy and sell. Price is a determinant of value in exchange. And what is value? Value means value in use. When you are using that particular thing, when you are putting that thing to use, that is value in use. Whatever use you are taking that particular good in, that use will be the value in use. So that will determine your value. So whatever you are getting is value, whatever you are paying is price. Obviously, whatever you are getting to ascertain it in monetary value is a difficult task, and that is the entire thrust of this particular subject called business valuation. We will teach you how to ascertain what you are going to get out of this asset. And look at Warren Buffett smiling at you, because he is very sure that all your doubts, all your apprehensions are going to be clarified after you study this subject called business valuation, because we are going to teach you how to come to a point where you ascertain what have you got in return. That is the crux of this particular chapter called the business valuation.